Debt consolidation, debt management, debt settlement. How are these solutions alike? How are they different? Hello and welcome to Headlines in Fine Print with Dion Williams, brought to you by Piedmont Advantage Credit Union. I'm Dion Williams, President and CEO of Piedmont Advantage Credit Union. On today's episode, we're going to compare and contrast debt consolidation, debt management, and debt settlement plans. The last few years have not been easy. We've had the pandemic. We're still in an era of stubborn inflation. We've had student loan payments restart. In short, there's been a lot of financial stresses on consumers and their families. So one of the things that there's no shortage of, though, however, would be quote unquote solutions. So today, let's get into the headlines and fine print of those various debt solutions. Let's begin with debt consolidation. So let's say that you have $20,000 in credit card debt, and that could be spread out among 4 or 5 accounts. And let's say also that those interest rates are more than likely north of 20%. A debt consolidation loan can help you wipe away those 4 or 5 credit cards into one loan and one monthly payment. The interest rate should be lower, the payment should be lower, and it would have you on track to pay off that debt much more quickly. Because with a credit card, if you're just making the minimum monthly payment, it can take years, if not even into a decade, to pay it off because you chip away at it so slowly. But with a consolidation loan, you've got a fixed term that you're paying on it, so when it's gone, it's gone. So that's the headline. What's the fine print with debt consolidation? The fine print is actually coming down to your behavior as a consumer. What do you do with those other cards? Do you close them out? Do you just quit using them? Or do you keep them open? Because in the consolidation example I just gave, let's say it freed up $150 extra per month into your budget. What do you do with that? Does it go into your 401k? Are you saving it into your rainy day fund? Now, what some folks did, and I used to work as a loan officer earlier in my career, and I saw this more often than I like, when the person had that freedom of that free cash flow and that lower interest rate, they would go back and run those cards up all over again. And the problem is kind of like building that house of cards, that you've got the regular consolidation payment, but then you start tacking on those credit card payments on top of it. So at the end of the day, where in one scenario you lowered your monthly payment by $150, down the road, you've got the consolidation payment plus 4 or 5 credit cards, and you're probably plus 150 or more with that new payment structure. So that's the danger of debt consolidation. It definitely requires some self-discipline and some budgeting on your behalf to let that solution work for you, though it can be a very good solution. And as an aside, Piedmont Advantage Credit Union has certified credit counselors that can assist you with that budget, and we also offer the consolidation loans. So that's something that you may consider if you're at that stage where debt consolidation is your option. Now, let's move to another scenario, which is debt management. In a debt management plan, you're going to work with a third party that negotiates on your behalf with other creditors. So if you have those 4 or 5 credit cards, instead of you consolidating them and paying them off, this company is going to work out a lower interest rate, maybe reduced fees, and you're going to make one payment to this debt management company, and they're going to disperse those funds on your behalf. So one of the fine print questions: is there a fee to this service? There is a fee, and that's built into your monthly payment. Part of that may come out of your payment. Part of that may be subsidized by the participating creditors. Now, I do need to note that not all creditors will participate in such a plan. If you have a secured loan, such as a home loan or an auto loan, they won't necessarily participate. And if you're having trouble making payments on one of those, you'll need to communicate directly with the lender to work on those. The debt management plans are geared more towards your credit cards and your unsecured debt. So the benefit of it is that you get the lower payment, the lower interest, which helps you pay off those accounts in a more timely manner. Another fine print question: are the cards open or closed? they're going to be closed. The third-party provider is going to require that you close out those accounts. And now in the short term, that could possibly hurt your credit because it's less credit available. But long term, and the big picture benefit here is that you're paying off that debt, you're reducing those balances, and it puts you in a much better position down the road. Now, if you participate in a plan, you may want to have it set up in a way that there's one card that you leave out of it because you may need that one card for an emergency, or sometimes if I'm making an airline reservation, for example, I like to do that on a credit card instead of a debit card. If there's fraud or something going on with it, it's easier to file the claims that way. So if you need a card for emergency purposes or a specialized purpose, you may want to keep it that way for that reason. So again, the fine print with the debt management plans is that there could be a short-term impact to your credit history. There is a fee to it. But again, the long-term benefit to you in terms of having that payment to eliminate your debt in 3 to 5 years, that is 100% to your favor. Now let's shift to the final one, but let me digress for just a moment before we get to debt settlement. One final comment on debt management plans is it is a far superior solution to bankruptcy. Debt management plan is going to be something that you're in it, you're out of it in less than 5 years, and the long-term impact to you is not nearly as drastic as someone filing bankruptcy. And let's transition to debt settlement, which I would say would be like that last step before a person may consider bankruptcy. So with debt management, a third-party company is going to work with consumers, and they're going to negotiate a lower payment and a lower amount owed. Literally, one of the things they're going to tell you is to stop making payments on your account. So with a debt management plan, for example, you're really not going to miss a beat with your payments. You're going to keep making those all along. But with debt settlement, you're going to stop making payments altogether, and the debt settlement company is going to use that as leverage to negotiate lower interest rate, lower payment, and lower total amount you have to pay, even in principal. Now, debt settlement plans, sometimes credit unions have relationships with third parties that will negotiate on your behalf to do that. But with a debt settlement plan, there are no such arrangements in place. You're seeking these out on your own. And again, that's the first fine print I want to reiterate for you, is that when you stop making those payments, and that's the advice that the debt settlement company is going to give you, that is going to absolutely have a material impact on your credit report, because you are going to show past due, and you could even go severely past due while the debt settlement company is negotiating on your behalf. Now, you will pay off the debt again in a timely period of time, such as 3 to 5 years under a debt settlement plan. But I would argue that the immediate impact to your credit report is far more severe than a debt management plan, because that period when you stop making payments, you're getting into that 60, 90-day period of being severely past due. So when you're in a plan like this, of course, you shouldn't be shopping for credit anyway. It should be more the focus of getting out of debt, but just want to be very clear that the short-term ramifications to your credit would be far more serious under this type plan than a settlement plan or a consolidation loan. And you could even be subject to legal action, because once you get 90 days past due on a loan, at that point, the creditors could pursue a judgment against you and try to put a lien against any property you have and things of that nature. So just keep in mind that with this one, I'm giving you a short kind of a worst case scenario over the short term, but over the long term, the plan is that you're going to have the unsecured debt paid off completely. And then you're going to have kind of a clean slate to start building from again. And it is a superior solution to bankruptcy, because again, the bankruptcy, depending on if you file a Chapter 7 or a Chapter 7 or Chapter 13, you're looking at a 7 to 10-year impact on your credit. Whereas with a debt settlement plan, it would be a shorter term impact, because you're going to have that paid off within 3 to 5 years in many cases. So again, we have debt consolidation loans, we have debt settlement or debt management plans, and debt settlement plans, And then on the extreme would be the bankruptcy. And we could do a whole episode on bankruptcy. But my message on bankruptcy is that should be a last resort and avoid that at all costs. And again, I'll point out that the credit union has the certified credit counselor resources as a starting point before you go down any of these paths, because a lot of times it's not an issue. There can be an external factor that's really weighing on you, but many times it is a budgeting, self-discipline issue. A lot of times you get into that trap of the money is taking you down a path instead of you taking your money down a path. So that's the kind of the common thread between debt consolidation, debt management, and debt settlement. Budgeting. Have a budget. Control where your money's going. As you listen to past episodes, you'll hear me say this a lot. Pay yourself first. If you pay yourself first and you very much are dictating where your money's going, build the emergency fund, save for retirement, save for those long-term goals, whether that's retirement or college education for your kids, and then kind of put debt on that back burner, because when you're paying debt first and debt is kind of controlling your whole check, it's a vicious cycle and it's a hard spiral to come out of. But remember, your credit union's here to help you with that. We're here to make it less stressful. We're here to help you with your choices. We're here to help you with your conversations and to build that discipline where you're controlling your money. So if there's one takeaway from today, I just want to say, please don't despair. You have options, and we can help you navigate those waters to consider what's best for you, short-term and long-term. Thank you so much for joining us for today's episode of Headlines in Fine Print with Dion Williams, brought to you by Piedmont Advantage Credit Union. Can't wait for the next episode as we continue to dive into topics that are of interest to you and really day-to-day consumer finance topics that make us all better financial stewards with our money. So have a great day, and we'll see you next time.